Okay. Good afternoon to all of you. On behalf of the Accounting Standards Board, I am pleased to welcome all participants to the webinar
Good
on
afternoon to all of you.
year-end
On behalf of
considerations, presentation, disclosure, and consolidation for the financial year 2025-26 finalization. As the financial year draws to a close, the emphasis shifts from routine accounting to a more comprehensive review of financial statements, particularly in terms of how information is presented, disclosed, and consolidated. This phase is crucial in ensuring that the financial statements convey a clear, complete, and useful picture of the entity's financial performance and position. Despite the structured guidance provided under Ind AS, year-end reporting often involves nuances, judgments, and careful interpretation. Matters relating to the presentation of line items, adequacy, and clarity of disclosures, and the robustness of the consolidation process require focused attention to ensure both compliance and transparency. This webinar aims to provide practical perspective on these areas, bridging the gap between accounting principles and their implementation. Through discussion and examples, it will address common issues that arise during the financial close process to presentation, disclosures, and consolidation. We trust that this session will add value to your year-end reporting approach and equip you with clear insights into these critical aspects. Thank you for joining us, and we look forward to an engaging and insightful session. We are privileged to extend a very warm welcome to our esteemed speaker for today's session, CA Parveen Kumar sir. Let me take this opportunity to briefly introduce him. He is a seasoned chartered accountant with over 3 decades of post-qualification experience and currently serves at partner and national head assurance, bringing extensive expertise in audit, risk advisory, forensic investigations, and IFRS implementation. He has been actively associated with standard setting and professional bodies, having served as a member of the AASB and earlier contributing to NACAS and various expert committees of the ICI. Over the years, he has led and advised on a wide range of complex engagements across corporates, including large-scale audits, fraud investigations, and IFRS transition assignments, demonstrating strong technical and practical insights. He is a widely respected speaker and academic contributor who has delivered sessions at national and international forums and has authored several publications and articles featured in reputed journals and magazines. We also have with us CA Prateet Kumar Mittal as a co-panelist of the webinar. Before we move into the technical discussion, it's my pleasure to introduce him. He is a chartered accountant with over 2 decades of experience in audit, accounting advisory, and assurance services, with deep specialization in corporate audits, IFRS, US GAAP, risk-based audits, and SOX compliance. He has extensive exposure to multinational corporations, Indian corporates, banks, and public sector entities, including significant experience in statutory audits, PCAOB compliant audits of US listed companies, as well as internal and forensic audit engagements. He possesses proven expertise in IFRS conversion projects and internal control evaluations across a wide range of sectors, such as manufacturing, FMCG, banking, NGOs, and government organizations. He is a regular speaker at professional forums and actively contributes to knowledge dissemination, including his involvement in revising educational study material for professional accounting courses. Over to you, Prateet sir.
Thank you so much, Rahul. So before we start the session, let me put the presentation here. Right. Okay, so first of all, let me take you through the flow of our today's discussion. So as you know, the topic is the year-end consideration related to presentation and disclosures. So we divided our presentation into three main parts. First is about financial statement presentation and disclosure matters, which is required as per Schedule 3, Ind AS, and accounting standards. So we'll discuss all these disclosures requirement, which is there. Second part is when you are preparing the consolidated financial statements, what is the key consideration you need to take care of? What are the disclosure requirements related to it that we are also going to discuss? And in the part 3, we'll discuss what are the recent regulatory changes which could impact your disclosure requirements. Either it is related to Ind AS amendments which recently came, or NFRA inspection reports which time to time has been issued, and the new labor codes which recently introduced. What could be the impact on disclosure related to this? So this is going to be a flow of discussion. To begin the session, I just hand over it to Parveen ji to just take you through a couple of slides to begin with. Then we'll take forward the disclosure requirement.
Yeah, thank you so much, Prateek. Thank you very much, Rahul, for your introduction. Prateek, you can put it on the full slide presentation mode. Okay, so dear professional colleagues, it's a great pleasure to be interacting with all of you again. This particular webinar on special consideration on year-end audit, I understand that this is in the series and this is webinar number 3. While the balance sheet has been covered, the statement of P&L has been covered. Now, in the third part, we will be covering on disclosure notes, accounting policies, and we will be taking care of, while presenting, we will be talking about Schedule 3 and accounting standards, all these aspects. Of course, we will also be touching upon the latest amendments. So we remain grateful to the Accounting Standard Board and the Institute of Chartered Accountants of India for giving us this opportunity to share our thoughts with you. A disclaimer first, whatever we will be sharing, these are primarily our own thoughts. These thoughts do not represent any organization or any institute. These are individual thoughts. In case you need to take any professional call, we strongly recommend that you refer the official literature which has been published by the Institute of Chartered Accountants, and you take your calls accordingly. So these thoughts which we share are coming out of our experience, and in the presentation we will also be discussing some examples with you, some personal experiences with you, some case studies with you. We wanted this session to be quite interactive. So whatever time we have, approximately 1 hour 40 minutes, 1 hour 45 minutes, we'll be sharing these slides with you, and we'll be sharing our thoughts on these slides. In case you have any questions, so I would recommend you can put it in the chat box or in the Q&A section. Then we can, when the time, if the time permits, and whenever there is a break in between, we will request the Institute technical team to share those questions with us, and we'll try to answer those questions which you may have. So this is basically, to begin with, one has to remember that when you're preparing these financial statements, they can be prepared on the basis of accounting standards which have been issued. Now, if you are a company, then the accounting standards are issued by Ministry of Corporate Affairs under approval of now NAFRA. Earlier it was NACAS. And if you are a non-corporate entity, then there are accounting standards which are issued by the Institute of Chartered Accountants of India. So while the ministry has issued accounting standards for companies, there are companies on which Ind AS is applicable, and there are companies on which Ind AS is not applicable. So both these type of standards are issued for the companies, and for accounting standards which are non-corporate entities, which are applicable to the limited liability partnerships, the proprietorships, the other entities as well. while there is a debate going on whether these accounting standards on non-corporate entities, whether there should be another set of standards for the people who are following cash system of accounting, but primarily as per the framework which has been issued by the institute on the accounting standards. This framework says that the accrual system of accounting is preferred because that's a better presentation. So we will be talking on these standards. There are some standards which are exempted for smaller organizations. Prateek, if we can go to the next slide. So if it is hanged, then you can stop sharing and you can share it again. So our purpose, objective of sharing, this presentation with all of you is that since the year has just ended on 31st March, so when you are preparing or you are auditing the financial statements, then you need to keep in mind there are certain, issues which may come up. So these are level 1, level 2, level 3 exemptions which are given based on the turnover and the borrowing limits. There are some exemptions which are there for level 2 companies and level 2 entities and then level 3 entities. And similarly, so what we are trying to convey is that whether you are preparing financial statements or you are auditing financial statements, you need to keep in mind that there is a compliance required for the accounting standards. But for the companies, there will be requirement of Schedule 3. But at the same time, if you are a banking company, then there are guidelines which have been issued by the Reserve Bank of India. If you are an insurance company, then there are guidelines which have been issued by the insurance regulator, IRDA. Yeah, if you are NBFC, if you are any other regulated entity, those guidelines have been issued by various regulators. And if you are a listed entity, then there are guidelines issued by SEBI. You have to ensure that all these guidelines are adhered to. The main objective of preparation of these financial statement is to help user taking a decision. Now, user can be internal users, which are the management, the auditors, the employees, or there can be external users, which can be the regulators, the investors, the people who are going to give funding to the company. All those people, whether internal or external, they are users of financial statements. And then these financial statements should be able to help these user taking a final decision. So this is the background, and this is the genesis of this presentation. So the way we are going to talk about it is, we will go through all the three sections which Prateek has mentioned. We will be speaking from both perspective. We'll be speaking from perspective of preparer of financial statement, which is primarily the management. We will, as a default, we will be using the company as a base, but then it can be applied to other entities as well, the thought process. So we will be talking from preparer perspective. And we will also be speaking about these issues from auditor's perspective. So while Prateek will take care of accounting aspects, I will be focusing that if you are an auditor, which all areas you need to be careful about. So this presentation I'm sure is going to help all of you, whether you are preparer of financial statements or whether you are auditor of financial statements. These considerations are very critical, very, very important. And we will take approximately, 1.5 hour or so to finish the presentation. So over to you, Prateek. It is still not showing on the presentation mode. So maybe you can stop sharing and share it again, or make it a presentation mode.
I think Not visible that side. So it's visible now.
It's on a split visible. I mean, it's not visible on the presentation. You
Okay.
just click on the presentation mode on the down. Yeah.
But next slide, it's not coming. Can you see the next slide now? No.
No.
Okay, let me share it again. So give me a second. I'll share it again.
Sure. So, Mr. Rahul, you can continue noting down in case there are any questions from the audience.
Yes, sir.
Can you see now pages? Don't know where. Can we go like this?
Yeah. You can just reduce the side portion and we can go with it. Yeah, please.
Okay. Okay. So, so how will we start? We will start because when you prepare the financial statement after balance sheet, P&L, and cash flow, the straight away the section do come is your significant accounting policy and notes to accounts. So how we are going to discuss it one by one? What are the key disclosure which we need to make in that section? We will discuss all those points. So when you start preparing your significant accounting policy, before that you just need to mention about the background of the company. You need to give the company overview. What is the name of the company, when the company was incorporated, then what is the nature of operation that company do. It is either manufacturing company, IT company, or do provide services. What are the principal activities they do, what are the business segments or geographies they do have their presence. All this information you need to mention in that paragraph. Plus you also need to mention what is their legal status, either they are public company, private company, listed company, if they are listed, on which stock exchange they are listed. So that complete paragraph you need to mention there. Plus, you also need to include in that paragraph if there any significant event happened during the year. For example, if any acquisition has been done, or merger has been done, or any restructuring has been done in the company, you need to give the explanatory paragraph about it. Or company, if company is in process of filing DRHP, that information need to be provided. Or is there any significant change in the ownership of the company? That information also have to be mentioned in that paragraph. So that's why this paragraph is important, because it's for the reader, it gives the background information about the company, which nowhere else you need to mention. This is the place where it goes.
So if you are auditing an entity's financial statements, and if you look at the background, generally what people do is generally they just copy and paste the previous year financial statements disclosures. And when you are doing the audit, it's very important to have a look whether the right description has been given. Especially, there have been changes in Ind AS, there have been changes in accounting standards. So people, because they are using copy paste, they forget to make those changes. And also, it's quite common that these significant events which have happened, they are also missed out. So as standards on auditing says, it requires you to, as auditor, to look into the other information which are published along with the financial statements. It's very important to see whether there is any inconsistency with the directors, board of directors report or DRHP. So, especially the companies which are going to go for public, you need to make sure that whatever information is there in those documents have been taken care of when you are preparing these background and these disclosures. These are very critical points, and auditors, you cannot afford to miss on this particular item. Yeah.
Okay. Moving ahead, the second section do come about the significant accounting policies. And the first section, which is critical here, is you need to mention about basis of preparation of financial statement, where there are certain important aspects which you need to disclose. Number one, what is the framework you are using for the purpose of preparing the financial statement, which is Ind AS or accounting standards plus Companies Act, or if you are using some special purpose framework, you need to mention that framework in your financial statement. Number two, the numbers which are there, you have used historical cost convention method. It means you have taken all the figures based on the cost plus minus depreciation out of it. Or if you are preparing the financial statement on realization basis, so you need to mention that purpose also. Thirdly, what is your operating cycle? That is very important to mention. Operating cycle depend on the nature of the company. It could differ company to company, but generally, if there is no clarity, what is my operating cycle is, generally we consider 12 months as a operating cycle period, because once you define your operating cycle, then only you will be able to classify current and non-current, which this concept will discuss in the next slide, but that is important from that perspective. So it need to be clearly mentioned what is the operating cycle of your company. Operating cycle means when your complete one cycle of the operation do complete, starting from your purchasing of raw material till the time you realize sale and realize the money. Once that complete cycle do complete, we call it as operating cycle. Then rounding off requirement. You need to now round off the numbers, depends on how much turnover you have. If your turnover is more than 100 crore, then you need to round off into lakhs, crores, lakhs, million, crores. Or if it is less than 100 crore, then you can go by in thousands also. So that is something you need to clearly mention, what rounding off you use in the financial statement. And functional and presentation currency. This is also important aspect, especially in case of Ind AS, because one company can have different functional currency and different presentation currency. Functional currency is something in which you generally company generally operates, and presentation currency is where you need to do the currency in which you need to do the reporting. If you see the next slide here, actually some differences has been shown. What is the functional currency and presentation currency? So currency of primary economic environments, the determination has been for the functional currency, determination has been done based on the your sales, your costs, your in which currency you are doing your financing. So these factors drive and to determine what is your economic functional currency. Generally, there is no change in the economic currency which have functional currency which happens, because you keep on doing the transaction in that currency only. And all the books of accounts which are maintaining, you maintain in the functional currency. Presentation currency is nothing, just the reporting currency. For it, why it could be differ? Because let's say you are a company, you are working in India, so all the sales, purchase, financing you have done in Indian rupees. So that's why your functional currency is Indian rupees. But if you are a subsidiary of any foreign company and they ask you to provide the financial statement in, let's say, US dollar, then in that case, your presentation currency or reporting currency will be US dollar. So that's why in that case, both the currency will change in your scenario. But in most of the cases, is company is in India, work in India, preparing the financial statement for Indian purpose only, then in that case, generally Indian rupees will remain the functional as well as presentation currency.
So when you will be looking into basis of preparation of financial statements, many times we have noticed even FRRB has given indicators and points which are being missed out by people is that applicable framework is missed out when they are mentioning it in their disclosure notes. Maybe some companies it was noticed by FRRB or even regulator, other regulators also. It is written that applicable framework is accounting standard, but accounting is done on, but actually they are applying Ind AS or vice versa. And then on the measurement also there is a confusion which happens. So one need to be very careful while preparing, while doing the audit of these financial statements. You need to put somebody on the job to do a base level checking whether these informations have been provided therein or and these are actually these are the correct informations. Yeah.
Right. So moving now to current and non-current concept, as we discuss, all financial assets and liabilities, you need to classify into current and non-current. And generally, current and non-current comes through what is your operating cycle in your organization. As I mentioned earlier, if it is not clear what is your operating cycle in your organization, you can safely assume 12 months period for the purpose of classification for current and non-current. But yes, it can purely depend the nature of business you are in. For example, if you are in a real estate company where the money do take the complete cycle do take more than 12 months to run, in that case your operating cycle could be more than 12 months. It's not necessary to be 12 months. So that's why it is important that you assess what is your operating cycle is, and based on that, current and non-current classification need to be done. Number one. Number two, 12-month period is not mandatory to follow in some scenarios. For example, if you have taken some borrowings and you need to repay it after 12 months, so you will classify it as a non-current assets. But the problem is there are some agreement which you have done with the banker side, and if you breach any of the covenant of that agreement, in that case, the contract says it will become payable on demand. In that scenario, your loan becomes current immediate basis. So you need to change the classification to current from non-current. So this is one of the scenario. Generally, it happens in case of contractual agreements that you do not comply all the conditions. For example, bank asks you to ask, one of the condition is of the bank that you will submit financial statement within 6 months. Sometimes you're not able to do so. Either you go there and take the waiver from the bank side, otherwise you have to reclassify your asset and liability in that scenario. Yes,
So
sir.
this particular aspect is quite subjective. And, initially when IFRS was coming to India, there was a huge, debate and discussion about how we will do current, non-current classification. And there were a lot of anxiety among the people that, okay, we have this particular item, it can be shown as current, it can be shown as non-current. There can be inconsistencies between the companies. There can be inconsistency between the years. So, and then there are certain items on which there were no answers. But now, when the Schedule 3 had come into the Companies Act, and over the period, over the years, when the balance sheets have been published, this matter has been sorted out. Now people are aware what is current, what is non-current. However, in some of the cases, these small little presentation issues, they create a challenge in the life of the auditors. Especially, like what is mentioned is about breaching of loan covenants, or this criteria of 12 months. As you are aware that in other places also, in Caro also, there is a requirement of reporting whether the short-term and long-term, short-term loans have been used for long-term purpose or not. There are various places where these current and non-current classification will have an impact. And also on your ratios, they will have a significant impact. So you need to be careful that whichever classification is shown, this is actually the classification as required by the Companies Act. Yeah.
Okay. So moving to the next item, which is critical estimate and judgment. This is also an important area where you need to take care of the disclosure aspects, because wherever the management use their own judgment or assumptions, they need to clearly describe it into the financial statement. For example, what could be the key judgment or assumptions where management could use? For example, useful life of fixed assets. This is the judgment where management use how much would be the useful life for a particular asset. Or ECL, expected credit loss. When you are calculating expected credit loss, that time management use certain assumptions for the purpose of calculating ECLs. What would be the probability rate? What would the discounting factor which will use it? So all these things need to be properly mentioned. When you are another example could be when you are calculating the impairment of the assets, and you are putting the cash flow of the next few years. How much would be the growth? What factor I will consider to discount my uh, revenue to current date, and then what would be the future expected expenditure in that to draw that cash flow. All these assumptions or judgment wherever management use, they need to make sure that has been properly been uh, disclosed in the notes to accounts, wherever the policy or other disclosure they are making in the statements. So moving to next section, which is accounting policy. So when the first question do come here, whether we need to mention all the accounting policies into financial statement, because there are too many India's accounting standards. So if there are more than 30 standards, so do we need to mention all the policies in the financial statement? So the simple answer is no, not required. You only need to mention the accounting policy which are relevant for you, or you have a transaction related to those policies. That is something you need to mention, because if you see the first point as even second bullet point, it says in case of India's material accounting policies to be disclosed. This is mentioned in our standards. So it means, for example, you are having some small income from fixed deposit, and you have not disclosed any accounting policy related to that income. So that is perfectly all right till the time that amount is not material for your financial statement purpose. But if it is a material, then you need to give a separate accounting policy related to it, that on what basis you are recognizing revenue on that fixed deposit. Similarly, in AS, the word has mentioned is significant, and in Ind AS, the word has been mentioned material, but the meaning of both the scenarios are similar. Then you need to be very clear that the accounting policy which you are mentioning, it should be relevant what you are doing and very specific. It could not be generic, or you cannot use the accounting policy of any different industry. It should be relevant in your scenario and should be specific to your industry. The accounting policy should be aligned with the Ind AS or AS. You need to see what is mentioned in the accounting standards, and according to that, you need to frame your accounting policy. Avoid general policies. If you have 3 different streams of the revenue in your organization, you cannot use one common policy for them. Unless and until the different streams, so there should be different policy. And this is the critical issue which has been recently been observed by reviewer also, and we have an example there. I will just share it with you. Even since it is related to audit, so better to Praveen take this up.
Yeah, actually, on January 7th, 2026, which is this year itself, NAFRA has issued a circular that auditors need to interact with those charged with governance. And most of the companies which are listed companies, they have put a framework in place where they have created a committee which is called those charged with governance. And that includes the audit committee people, audit committee chair, and the management top management also. So when you will interact with the top management, one of the area which you need to share it with them is about your audit planning, before start of the audit. And second meeting will happen when you are about to conclude the audit. So in the first meeting, when you will be sharing your audit plan, you have to mention about how you are going to do the audit, which are the key risk areas, and as defined in the standards, revenue recognition is one of the fraud risk areas. Of course, the other area is management override of control. These are the 2 areas where there are significant risk areas. So both these areas need to be mentioned as you are going to have a focus on these areas. So what people do is when they form their accounting policies, they mention a generic accounting policy, which is primarily a copy paste from the standard itself. That is not what is expected from the company as a preparer of financial statement or the auditor who are reviewing the disclosures and giving their opinion, audit opinion. So the commonly what people do in many cases, they just Control C and Control V. They do copy paste from the other published financial statements, or they just copy paste from the standard. But many times, they realize, the regulators or the FRRB or the reviewers, they realize that probably either the policy is not being followed by the company, what practice is being done is different, what policy is showing something different, or they are giving a very generic kind of policy disclosure. So in the next slide, we have put an example where if you go to the next slide, so there are many activities which are being run by the company. There can be construction contract if it is a real estate company, the example we are sharing. Second is there can be sale of residential apartment. and there is a booking done for this, and third is facility management. If the company is giving only one generic revenue recognition policy, that we are recognizing revenue on the basis of risk and reward, or we on the basis of accrual system of accounting, just this much, this is not sufficient. There are three different revenue streams. So all how the revenue is being recognized in that stream, that needs to be disclosed separately. So in the next slide, we will show that how correct treatment can be done. That each stream, there is a different policy, how the revenue is recognized. And probably, this is one area where you all need to be very careful. This is an important consideration. So if you are doing audit of a company which is having different revenue streams, you need to make sure that the disclosure is done by the company for each of those revenue streams. So always remember that when you are communicating with those charged with governance, you have to mention what is the responsibility of the management and what is the responsibility of the auditors. It is management responsibility to pick up and draft the accounting policies and follow those accounting policies. It is a responsibility of the management to maintain the books of accounts and to follow these accounting policies. It is a responsibility of the management to ensure that internal financial controls over financial reportings are operational and are adequate. It is a responsibility of the auditor to see whether whatever management is saying, whether it is being applied, and whether there are any gaps therein, any variances therein. So the critical point which we want to convey here is that disclosure of policy, especially related to accounting policy, especially related to revenue recognition, need to be elaborate. And even in their orders, NAFRA has also, picked up this point, and they have mentioned that auditors missed out on ensuring that the proper disclosure of revenue recognition policy has not been done. So in order to see whether the accounting estimates or judgments are done properly, as auditor, you need to challenge whatever assumptions have been taken by the management, say in terms of percentage of increments which are going to be given to employees, in order to understand what is the gratuity amount, how the calculation of current year expenses are being done by the actuarial. Whatever assumptions are there, auditors need to check. So now, how will you demonstrate that you have carried out that exercise? And this is a very important aspect, that your work papers, the audit work papers, should have those audit query memorandum or the questions which you are asking from the company management. They can be in a format of audit query memorandum. They can be in a format of a simple email. They can be whichever way. You need to demonstrate the management regulator that asked these questions from the management, and you got answers to that. So this presentation policy, you need to be really very careful, because this is one thing always under scanner. Yeah.
Okay, so moving forward, so we just list down certain areas which are related to key accounting policies, and generally it need to be disclosed in your accounting policy section. So either it is revenue, leases, the policy around leases, impairment of assets, provision and contingent liabilities, property, plant and equipment, how you're recognizing it, policy related to taxation, post-employment benefits, segmental reporting, as well as financial instruments. So these are generally the key accounting policy which normally comes into the financial statements disclosure. Apart from that, if you have any specific transaction, something, you need to make sure that policy is there, because you have to see all the accounting standards, and if it is there, the accounting standard is there on that, you need to mention the accounting policy also in financial statement. Okay, so now we will move the key disclosures which is required as per the Schedule 3. Now, there are certain disclosures which Schedule 3 prescribes, which is not there in accounting standards, but Schedule 3 prescribes that you need to disclose in the financial statement. So before we come to that, let me tell you how the Schedule 3 is structured. Schedule 3 of the Companies Act 23 has three parts, three divisions to it. First division talks about the companies which are following accounting standards. So what disclosure they need to make, how they need to make. Part 2, division 2 relates to the companies which are following the Ind AS, and 3 relates to non-banking financial company. So depends on which accounting standard you are following, you need to follow that division of the Schedule 3 for the purpose of taking formats and disclosure requirement related to the financial statement preparation. Okay, so what are the specific requirement of Schedule 3? Number 1 is related to corporate social responsibilities, CSR expenditures. So as you know, Section 135 talks about that the companies, if they have profit of a certain more than certain limit, they need to do CSR activity. And if they are doing so, they need to disclose all about that in their financial statement, notes to accounts. What the disclosure requirement is, you need to mention the amount required to be spent by the company during the year. So if your profit is, let's say, 10 crore, if you need, your threshold is 2% of that, you need to mention that amount. This is the amount I need to spend this year. And out of that, how much amount you already spent, the expenditure incurred, that amount we will go. How much is the shortfall in the year, which you're not able to do the expenditure, you need to mention that amount. What was the total shortfall of the previous years? What is the reason of the shortfall? What CSR activity you have done? You need to give the description of and nature of that activity. And if the contribution has been done or expenditure has been done with a related party, to any related party, then in that case also you need to mention this in your disclosure. And if any liability is there, you need you have made any provision in the financial statements, that amount also need to be shown in the disclosure. So this is very specific disclosure requirement from the CSR perspective. Treatment in books, as you know, CSR expenses need to be recognized in profit and loss accounts of that year where you are doing the expense. Then the other requirement is about disclosing the undisclosed income. So it says, the requirement says, if the company have any income which has not been recorded in the books of accounts and it has been disclosed to any tax authorities under any tax assessment, survey, or search, under search, then that amount and that description need to be disclosed in your notes to accounts. Cryptocurrency and virtual currency, though it is not very popular in India as of now, but if you are dealing in cryptocurrency or virtual currency, so you need to give details of those transactions, that how much profit you incurred on those transactions, how much is the currency held as on reporting date by the organization, and deposit or advances from any person for the purpose of trading. If you have taken any deposit or you have given an advance, that also you need to mention in your disclosure.
Just to mention here that, globally, there is an issue of, from perspective of the auditors, that in case there are cryptocurrency transactions, so how the auditors are going to review and how the auditors are going to, create evidence to ensure that, whatever opinion they have arrived at, whatever view they have arrived at, so whether that is supported by some evidence, some kind of what kind of audit procedures are required to be done. And we are expecting some guidance which will come out of International Auditing Standard Board, or some there is a debate going on, there are discussions going on, there are papers which are in the process of coming out. So keep looking, keep a watch on this particular area. So in case our government or our regulators, they accept cryptocurrency as one of the currency, or uh, whether there are any developments happen. So I think it is important to keep a watch on this particular area, and in case there are any guidance which comes from the global organization, so as auditors, you need to be extremely careful. Yeah. Yeah, please continue, Pradeep.
Okay, so the next important requirement is about MSME disclosure, and this is the area where lot of discrepancy has been noticed in past, because this disclosure is generally is not complete in many cases. So what the disclosure says, first of all, let's understand what is MSME. This is micro, small, medium enterprises, and micro means if your turnover is less than 10 crore and your investment is less than 2.5 crore, then you are micro. Similarly, if your turnover is less than 100 crore and your investment is less than 25 crore, then you come under a small category. And if your turnover is less than 500 crore and investment in plant and machinery we're talking about is less than 125 crore, then it is a medium entities. So in that case, the law says that you need to the company need to make the payment to these entities on a timely basis. And if they fail to do so, there are certain requirements to disclose in your, you need to pay certain interest on that, and you need to do the disclosure about it. So what disclosure requirement is? Number one, you need to show the figures related to the principal amount and the interest due thereon. Whatever principal is remaining unpaid and interest is remaining unpaid, you need to mention that amount. The amount of interest paid by the buyer, if any interest you have already paid, that amount need to be mentioned. The amount of interest due and payable for the period where the principal has been paid. If the case is like this, you have paid the principal, but interest is due, then that need to be shown separately. Then fourth number is the amount of interest accrued and remaining unpaid at the end of the accounting year. So if any interest which is accrued and not yet paid, that need to be, and outstanding at the year end, that need to be mentioned. And then the last point says amount of any interest due and payable even in the succeeding year. That amount has also need to be calculated and has to be shown separately. So this five requirement has been given as far as the MSME disclosure is concerned. And what we have seen, I have taken one extract of a listed company's financial statement just to give you example how this disclosure will come. So they have list down all these five requirement here separately. If you see, the figures generally do come in only two sections. One is the amount remaining unpaid at the year end for the principal and interest, these both amounts, plus amount If you see the number 4 point, the amount of interest accrued and remaining unpaid at the end of the accounting year. So generally, these two figures company do disclose because very few companies who are paying interest on it. So that's why if you see the column number, the row number second and third, point number 3 are there no figures, because companies are number one, no companies there which is only paying uh, interest. So that figure is not there. That's why. And very few companies would be there who are only paying principal and interest is due, they are not paying the interest. So that's why these figures are generally nil in most of the cases, and these two figures do come. But still, if you have any such figures, you need to disclose it properly in your notes to accounts. Because in case of NFRA also, this query has been raised multiple times.
So this is very important, MSME, as you are aware that under section 43BH, there is a disallowance which you are supposed to make a disclosure when you are doing tax audit under clause 22 and 43 of the form 3CD. So what you are supposed to do is to ensure that compliance of section 15 of MSME Act is very, very important. So how the auditors will need to do? One is to see that identification of vendors which are MSME, whether that identification has been properly done or not. And that's one of the major challenge, because auditors will send a letter to, or the company will send a letter to so many people. And now there are some tools which are available in the market where you can put in the name and address, and they will, this tool will search the net and will let you know whether there are MSMEs or not. The most of the companies are doing it like this. Some of the large audit firms are doing it like this. But very important is to identify whether the vendors are correctly identified as MSME or not. That's one area of consideration for the auditors. And the second area is that whether the disclosures are accurate or not. Also, you will need to collaborate and connect with the Form 3CD when you are doing a tax audit, and you will need to make a disclosure of the amount which are not allowed or disallowed under the Income Tax Act to be taken as an expense. This is from last 2 years, this has become a critical area of working for the auditors, and there have been a lot of challenges, especially when you are doing audit. You will need to make sure that this reconciliation is there. So there is a risk that whatever is being disclosed here and whatever disclosure you are doing in 3CD, they need to talk to each other. And you need to ensure that your audit work papers are containing the information, how you collected this, how you ensured the completeness, the accuracy, and how you have put it into the 3CD form. So this is something which is very, very important point, because when the regulator will look at this disclosure note and your 3CD, they will immediately be able to make out whether there is a reconciliation issue or not. So this portion you need to be extremely careful. Yeah.
Okay, coming to the next point, which is related to contingent liability and commitment. This is also an important section as far as the disclosure is concerned. Because if there is any contingent liability, you need to disclose the details about it. But it could be claim against the company not acknowledged as debt. It means if some assessment is going on and you receive a notice from the tax officer side, so you need to provide the provision. You need to disclose in the notes to accounts, or you just not need to do anything about it. This is something you need to decide. And what is the criteria to decide it? We call it a PPR assessment, which is probable, possible, and remote scenarios. What happen is if you receive some let's say some notice from the tax officer and you are not a tax expert to decide what could be done, whether I will have to pay this liability in future or not. So then you take the PPR assessment from the tax experts, and if they say there is a remote chances that you need to pay this liability, then we don't do anything about it. If they say there is a possible chances, it means though there is no percentage attached to it, but generally in likelihood we take there are chances 10 to 50% somewhere between, then we consider it as a contingent liability, and proper disclosure of that thing we need to provide in the notes to accounts. But if the assessment do say there is a probable chances that we need to pay this liability, in that case it is not a contingent liability, it is a confirmed liability, and you need to provide a provision in your financial statement. So that's why when you are assessing the contingent liability aspects, PPR assessment is important. You need to do this in most of the scenarios where the claims are there, especially any litigation claims, any tax assessment claims. There you need to do it. Plus, guarantee, if you are given any guarantee, financial guarantee to your subsidiary or corporates, then you need to mention that details also. Or if there any other money which is related, which is a contingent nature of things, where you see there is potentially it could be liability on the organization in future, then you need to give the detail about those contracts. The similar way, you need to mention the commitments also. If you have some significant commitments and you have entered some contract where there is the significant outflow or commitment is there, either it is generally it happen in the case of capital sort of expenditure, then you need to provide the detail of those. Any uncalled liability on share or investment side, that also need to be mentioned, or any other commitment which you have given in the in your business side, you need to mention the details of all those commitment also in your notes to accounts.
So for auditor, it is important that whatever contingent liabilities have been disclosed, you need to not only take the information from the company, but also challenge it. Because many times the audit field team will say that, okay, sir, we have received, the company has done PPR, company has put this into probable, this into remote and all. But whatever company has done, as auditor, you will need to challenge. There may be a chance that on the basis of your interaction, your interview, or your reading of the situation, the identification of that contingent liability might not be correct or might not be fair according to your opinion. So you need to make sure that you challenge. This is what we call professional skepticism. Whatever information is being given by the company to you as part of the disclosure notes, as part of the accounting policies, as part of the whatever information is being provided as an evidence to whatever being disclosed in the notes to accounts, you need to challenge those. And that professional skepticism and that challenging need to be recorded in your work papers. You need to put it into your work papers that this is how we asked this question, and this is the answer we got, and this is the third party evidence which we have received. So there may be a situation that a company may have, let's say, 1,000 cases going on. It's a large company and they have put it into different categories. But you can pick up a sample, ask your team or ask an independent lawyer to look into that, and then get an understanding whether this this categorization by the company is fair according to you or not. So this is something which needs to be looked into. And always remember that professional skepticism is the base for your auditing. It's not the company has done the information and provided the information, but also you need to challenge that information. Yes, Prateek.
Okay, so we put one extract of the financial statement here just to give you a glimpse that how this disclosure will be made. So if you see on top, I'm sure it would be visible a bit to you, but if you see on top there is a accounting policy which has been mentioned related to this. Then there is a line by line disclosure on the contingent liabilities and commitment both. The figures are mentioned here for this year as well as previous year. Then there is an explanatory note of for the each figure. Only mentioning the figure is not sufficient. You need to explain, what are the matters related to it, at what stage it is and why you are considering it as a contingent liability. So this is something you need to mention in notes related to every figure which you are mentioning in the notes to accounts. Then there is a separate note on the legal proceedings also, which you need to explain at what stage it is the case is. So this is just to give you a glimpse how the disclosure will go. Okay, so moving forward.
There are some additional regulatory disclosure requirements, which is like you need to mention about ratios. You need to mention about whether the title deeds are in the name of the company. They are all coming out of requirement of CARO. So as you might be aware, that there was an amendment which was done in CARO, and the auditor community, they went to the ministry and said that you are asking us to make a report, but where is the management making a disclosure of all this? So then they made amendments to Schedule 3, and then these items have come into play, that management will have to first make a disclosure, and then the auditors will give their report on whether the title deeds are in the name of company, whether any Benami transactions are there, whether borrowing secured under current assets, or whether any willful defaulter has been declared by the bank or not. Also, large number of ratios which are required to be disclosed. If we can go to the next slide. These are the ratios which required to be disclosed by the company, because ultimately the auditor will have to give their opinion, on whether the presentation is true and fair. So when you are given the financial statements prepared by the company, and in that there are different ratios, current ratios, inventory turnover ratios, all these ratios are given. You need to make make your audit work paper in such a manner so that you are able to demonstrate that you verified, you reviewed, and you challenged these ratios, and ratios are giving true and fair picture. In the next slide, there are some disclosures which are according to the accounting standards. So what we will do is, there are requirements under Schedule 3. When the company is making a disclosure under Schedule 3 and the details are coming out, as auditors, your responsibility is to check, your responsibility is to challenge, and your responsibility is to ensure that you have enough audit evidence and enough audit work papers to demonstrate to the regulators that when you reach to the opinion about true and fairness of the information provided in therein, you are doing your duty as a professional. So many people, they say that, the regulators are tough. They are looking at our work papers. Actually, if you have your work papers in place, if you are able to demonstrate that you carried out your work in a most professional manner, and you documented all the questions which you have asked, there was a professional skepticism, you challenged the company. So the regulator will understand that you did your job well, and whatever is coming out is a separate thing. Now, after looking at Schedule 3, we will go to disclosures which are based on accounting standards. We will go through these, but please remember, when you are making your work papers, your checklists, they all need to be there. When you will be interacting with those charged with governance, there is a very high probability that people in that committee may not be from the accounting background. So there may be a situation that you might be required to explain a little bit about various technical terms which are being used in accounting. So this is what is coming out of our own experience, that when we interact with those charged with governance, some people who are expert in their own domain, but not from accounting background, they may ask you a question that how and why these informations are there. So you need to have your own explanation, and they should be in place. So over to you, Prateek.
Okay, so now moving to the key disclosure requirement, which is driven by accounting standards. So first is related party disclosure. I think this is very important. Wherever you need to, wherever you have any transaction with your related parties, it is important to disclose it properly in your financial statements. And the standard says there are 5 key items which you need to disclose it. Number 8, the name of related parties. Whatever related parties you have, you need to mention those parties and what is your relationship with them. So the nature of relationship also need to be, if it is your subsidiary, your holding, your group companies, your fellow subsidiary, whatever the nature of the relationship is, you need to mention it there. Number 2, description of the transaction during the year. So whatever transaction, you just only mentioning the figure will not suffice the purpose. You need to describe if it is a purchase, it is sale, or it is reimbursements, whatever the nature of the transaction, you need to mention that description of that. Then, of course, the amount of transaction, whatever you transaction has been done during the year, you need to mention the amount of that. Then what is the outstanding balance as on year end? You cannot show net balances. If it is payable and receivables, you need to show it separately, even though it is related to one party. So you need to show payable and receivables separately in your disclosures. And if there are certain key terms and conditions that also need to be disclosed.
So one point which I want to mention here is that please note that law or the standards, they are not saying that you should not have transactions with related party. They are not saying like this. What they are saying is, in case there are related party transactions, please make a disclosure. So it's absolutely fine to have transactions with your related parties. Only requirement is comply with the regulations which are there in the Companies Act if you are a company, and make a disclosures in the financial statements that okay, these are the transactions with my father, with my brother, with my subsidiary, with my other companies. Nothing wrong in it. So please do not get that perception that related party transactions are prohibited. It is not like that. It is all, what is required is that you need to make a disclosure, and that disclosure is going to help user understanding, will help the user to understand the situation, and will say that, okay, fine, there are transactions and these are the transactions which are embedded in your financial statements. So actually, I am aware that these transactions are with these related parties. So there's nothing wrong in having related party transactions. Again, repeating, what is required is to please make a disclosure. And as an auditor, Your challenge comes when you will need to identify, or when you need to review whatever management has disclosed as a related party, whether there are any other parties which fall under that category or not. So your checklist or your query to the management needs to be quite elaborate so that you're able to have a right answer from them. So this is what I wanted to talk about it from consideration from auditor's perspective. Yeah.
So we put a practical issue here, which was faced recently, that there is one group parent company has given the advance to its subsidiary company of 80 crore rupees during the year, and out of that 65 crore rupees has already been repaid by them. So the finance team of that company disclose in their RPT transaction that loan to subsidiaries, and they have shown 15 crore as a net movement in the disclosure side. So the issue do arise here in this scenario. The netting of the amount, which is 15 crore, is not a right disclosure here, because there are two separate transactions which happen. One is netting 80 crore advance which has been given, and then there is a repayment of that amount has been done. So both these amount should have been disclosed separately in your disclosure. So that's why if you see, this has been discussed, because the right treatment is that both the amount should have been disclosed separately, and apart from that, you also need to mention what was the interest charge. It was free of interest, or what was the rate of interest on that, whether the transaction was on arm's length or not, what were the terms of repayment attached to this transaction. This, in addition to only giving the figure, you need to mention all this disclosure also in your notes to accounts. And as we mentioned, this is the important disclosure, because this is a very common finding which has been done by NFRA also in their recent reviews. Okay. Now coming to the next area, which is revenue. What disclosure we need to make on the revenue side? So there are pretty straightforward disclosure which is required. Number one, disaggregation of the revenue, and it means you need to give the breakup of the revenue. Either it is product wise, service wise. If you have a geography wise, then you need to give the geography wise also breakup, and timing wise is something you are recognized on immediate basis or deferred basis, then you need to give that breakup also. So disaggregation of revenue is first aspect which you need to give the disclosure is. Then secondly is your contract assets or your contract liabilities. Contract asset means if there are unbilled revenue in your organization, your business is such there are unbilled revenue, then you need to show it separately and give the details about the unbilled revenue, why there is an unbilled revenue. Similarly, if there are deferred revenue or unearned revenue, it means you receive some advance from your customers, then you need to show it separately and give details about it. Thirdly, the things will come if there is significant judgment involved, or if there is a variable consideration in relation to any revenue. That conditions you need to disclose in your, if your revenue depends on a certain conditions, you need to mention all those conditions in your disclosure part. One of the important aspect here do come principal versus agent relationship. Principal, if your revenue is such a nature, you are an entity which is recognized a revenue. If you are doing it on a principal basis, then you need to mention about it. Or if you are doing on agent basis, then also you need to mention about it. If you are a mediator, generally where this concept do arise is, if you are a mediator in some transactions and you are only doing the pass through of the revenue from one party to another, in that case, this relationship need to be, clearly identified that you are a agent or you are a principal. If you are a agent, then you need to recognize the revenue on net basis. And if you are a principal, then it will be done on the gross basis. If we take an example in this case, for example, let's say online shopping, you do online shoppings. Let's say you are buying air conditioner from Amazon. So, and what Amazon do, Amazon, do the sales to you. But on the back side, they have a back-to-back arrangement with the air conditioner companies. For example, Godrej, they have a tie-up. So ultimately, though you are making all the payments to Amazon, but ultimately you buying the AC from Godrej only. They will provide all the warranty. They will do all the installation, everything. So in that case, Amazon is a only mediator. The money which you are giving to Amazon, it's only passed through to the Godrej. So in that scenario, Amazon cannot recognize the complete amount as a revenue. They will only recognize on a net basis only their commission which is there. So that's why in every revenue transaction, it is important to identify you are playing the role of a principal or agent. And based on that, you need to disclose it in your notes to accounts, that policy. And then last is if there is a remaining performance obligation is there. So that amount and timing that you need to disclose in your disclosure. This is about, okay. So then the next key disclosure which comes is related to your lease transaction which you done. So in most of the cases in lease, what you do, either it is right of use assets, which is if you have taken some item on the lease, so you have to show a reconciliation sort of it. What was the opening balance, how much addition has been done during the year, how much depreciation is there, and then closing balance. So similarly, because if there is transaction or right of use, similarly you will recognize a lease liability against it. So that reconciliation you have to show in lease liability also. Opening balance, how much interest has been acceleration during the year, payment. So this walkthrough of from opening to closing, you have to show in both the cases. Then how much is the maturity analysis is there for lease payment in less than 1 year, 1 to 5 years, and 5 years. That amount, that disclosure need to be made. If there is any short-term lease expenses less than 12 months, generally we call it operating expenses, how much which directly has been charged to the P&L, that amount need to be shown separately. Or if there any low value assets item that you charge into the P&L, that also need to be shown. If any significant judgment has been used, for example, renewal of, if you have taken some lease and there with lease there is no lock-in period only, and it says it is subject to renewal, and you are considering renewal period also when you are estimating the life of that asset. In that case, in that sort of scenarios, you need to mention all these judgments which you have taken in your calculation, that you need to disclose in your financial statements or notes to accounts. Moving to the financial instruments. So you might be aware of that you need to classify the assets and liabilities, depends on their nature. If you are mentioning it on amortized costs or fair values through OCI or fair valuation through P&L, you need to separately mention all these categories into the into the notes to accounts. Whenever you are preparing the schedule of that, you need to separately mention it. Plus the ECL model which you are preparing for the purpose of impairment calculation. So that also you also need to mention on what basis you are calculating the ECL. If it is stage 1 and 12-month ECL you are calculating, that disclosure need to be go properly, or stage 2 where lifetime ECL, or stage 3 where lifetime ECL need to be calculated. All these disclosures properly need to go, and you need to give the basis also on what basis you are considering is stage 1, stage 2, or stage 3. So that disclosure will go. Trade receivables, as you know, always been considered on the lifetime ECL basis. So simplified approach has been used on that case. So that disclosure also need to be go accordingly. On the earning per share, as you know, the basic and diluted earning per share need to be calculated, and on the face of P&L, you need to show it. But you need to show in notes what is how you calculated it. What was the number of shares? What was the profit? How you calculated that number of shares? That calculation need to be shown there. And if there is a instrument which is diluting your EPS, so nature of that dilution also you need to mention. If there are convertible bonds, warrants, or some ESOPs due to which your EPS has been diluted, you need to give the details of those dilution into the notes to accounts, and how your diluted EPS has been calculated. That information need to be given in notes to accounts.
So when we are, when we are doing a review of, when we are doing audit of these informations which are being disclosed by the company, your audit work papers, like I had mentioned, should clearly have a reconciliation, the questions which you have asked and the answers which you have received from the management. Now, another challenge which we are seeing nowadays is about archival of the information. You received a paper from the company, the timeline is very near, so you just keep the file, keep the papers in your drawers, and once the sign off is done, then you are taking the paper out, putting it into the files. That is, for that, there are some time, which is given or allowed. But nowadays, most of the audits are being done on computers. So you have received an Excel sheet from the company on the email, and you have received Word document. Your people have created a MS Word document. Always remember that whenever you touch, whenever you make any amendment, the software will capture that this amendment or this file was opened on this particular date. So now the regulators will look into it that, okay, audit was signed on this particular date, but after 2 days or after 5 days or after 1 week, this file was worked upon. So the regulator will say that how can you work on that file after you have done the sign off, after you have reached the true and fair view. When you have formed your opinion, how can you alter your work papers accordingly? And this is a matter of concern, especially by NAFRA, when your work papers are being touched upon after the date of sign off. So you need to ensure that if you are working on a manual work paper, you will get time only for putting it into the file and sequencing and all. You cannot obtain further evidence from the client after you have done the sign off. So whatever work papers you are creating, or if you are using the audit software, or if you are using the Excel sheets or MS Word files, please be extra careful. You may come back and say that, okay, I am doing audit of a very small company. It is a private limited company. Husband and wife are the directors and they have a registered office at their home only. And this company is doing only trading, no complex transactions. So why should I bother about, collecting the audit evidence and all? It is required, I'm telling you, because in future, you never know what is going to happen. There may be a investor who may acquire this company, and that investor might be a listed company, or there can be a private equity fund which may like to invest into that company. And later on, there might be some investigation. Matter might go to the court of law. There may be some regulator looking into this private limited company. This private limited company might go for bank borrowing, and then the bank will start doing some investigation. They may ask, some regulator to look into it. There may be some issue related to foreign transaction of this company. Then ED might ask you to, present the work papers, how you did the audit. So all these unforeseen circumstances also to be kept in mind, and all you need to do is to adhere to the guidance which have been given by the auditing standards. So when you are doing the audit, or when if there are financial statement disclosures are made, whatever questions are there, you can put it in writing, whether on the software or in the manual work paper. So whichever way you are doing, please keep your audit work papers in place. And as I had mentioned, professional skepticism will be seen by the regulators. You need to ensure that whatever question you have asked, whatever management is providing you, you need to challenge that. And whether it is related to EPS, whether it is related to RPTs, or it is related to ECL provisioning, whatever the activity is being done, you need to really challenge it and keep that record with you, that you have challenged it before you signed off the financial statements. Yeah, please continue.
Okay. So now we'll move to our next section of the presentation, which is related to consolidation requirement and its disclosure. So when the company is preparing consolidated financial statements, of course, there are certain requirements which is not applicable, but there are certain additional requirements for the disclosure. We will come to that, but before that, actually, how the company do prepare the consolidated financial statements, they need to include all the subsidiaries financial statement, that is clear. Secondly, from the perspective of Ind AS, it is important that company do properly assess the control definition, because based on the control only, then you will be able to assess whether it will be line to line consolidation or it will be consolidation as per equity method. So it is important that you properly assess the control definition before doing the consolidation of any entity, either it is subsidiary or a joint venture, anything. Control definition need to be assessed. Now we'll come to what is the specific requirements. So when you are doing the year-end consolidation, so there are certain aspects which you need to take care of. First is, have you drawn the proper group structures? What are the total companies which are there in the group? How many, which are subsidiaries, which is associates and JVs? As I mentioned, you need to properly assess the control aspect of those entities, because then only you will be able to identify how the consolidation need to be done, line by line or equity basis. Then if the consolidation has been done on the first time, you need to see what Is there any goodwill or capital reserves which is there, which you need to account for? You need to carefully identify the intercompany elimination which need to be done on the transaction level, on the outstanding balance level, or unrealized profits which are sitting in your inventory or PP. Plus the computation and allocation of the non-controlling interests. That aspects need to be properly taken care of. Plus the last important aspect is alignment of accounting policies. So whatever entities you are consolidating, you need to make sure the accounting policies are aligned. This should not be the different accounting policy of one aspect in subsidiary and the different policy on head office level or parent company level, because then the consolidation would not be feasible. So you need to align the accounting policy, whatever entities you are consolidating.
So we have received a question from Mr. Rahul that where an investor holds less than 50% equity, but has contractual right to appoint a majority on the board and direct relevant activities, how should one evaluate whether such rights confer control rather than, merely protective rights under India's 110? So this is something which is a very common, questions. So thank you, Rahul, for asking this question. So primarily, when we will look at control under India's 110, there are three components which we need to be careful about. Although this session is not about India's 110, but still to put things in perspective. One is that you need to have a power. Second is you need to have exposures or right on variable returns. And third is you should be having an ability to use that power. So as you are aware that India's 110, it is all on substantive basis. It's all substance over form, which is important. So a company may not hold 50%, but may have a control. So this control definition is something which is very, very critical for anyone to understand. So you need to have not only the power, but also ability to use the power. That ability is very critical. So if you have power, even if you are not having 50% shareholding, but you have power to, on those decision-making process, and you have ability to use the power, then the control will be established. And once the control is established, then you will need to do consolidation, which is line by line. And whatever is left out, like in our case, for example, the shareholding is only 40%, but you have a control. So balance 60% is non-controlling interest. And that's the reason why the word minority is not being used in accounting nowadays. That's the reason why non-controlling interest word is being used, because those people can be more than 50%. They are not minority, but they are non-controlling. So this is something which we need to be careful about.
Okay. So moving forward, what are the mandatory eliminations which we need to do when we are preparing the consolidated financial statements? So it generally are intercompany revenue or purchase or expenses. So any intercompany revenue which has been done, or purchase transactions, or any expenses which are lying in each of the books, we need to eliminate those transactions. Plus, if there is outstanding balances as on year end, either it is receivable, payables, or even the loan amount which is outstanding. One company has given to another. In one company, it would be receivable, and another company, it would be payable. So we need to knock off both the transactions. Plus, if there are any dividend paid by the subsidiary company, and which is included in the income of the parent entity, that income need to be eliminated. if there are if one company has sold inventory to another company and it is outstanding in other company as an inventory, so whatever the margin which has been charged by one company to another, that margin, or we call it unrealized profit, that margin need to be eliminated from that inventory which is lying as on closing date. The similar way, if there is some unrealized profit is lying in fixed assets which has been transferred from one company to another, that profit also need to be. Generally, the key eliminations which might be required to be done when we do the consolidation activity. Okay, so Parveenji, over to you on this slide.
Yeah, so basically, when we are making a disclosure on consolidation, there are some errors which were noticed by Financial Reporting Review Board and by the regulators and NAFRA and Quality Review Board. Many times, intercompany profits are not fully elimination is not done, partial elimination is done. Many times the reconciliation is missing, and basically intercompany loans, there is a lack of disclosures or elimination was not done. So this, elimination part is very, very critical. You need to make sure that, whatever company is making a disclosure, there are, some sort of documentary evidence which is available with you, which will ensure that the complete intercompany elimination has been done while doing the consolidation. You can go to next slide, and then I'll talk a little more. So there are some disclosures which are not required and some disclosures which are required. So as you are aware that, when you are doing a consolidation, the CARO reports of the subsidiary or the component, except whenever there is a qualification, you need to mention in your consolidated financial statements audit report. Otherwise, the analytical ratios or title deeds or registration charges, these are not required. But in the next slide, we are saying that there are some disclosures which are required when you are preparing the financial statements. But please remember that materiality as one of the characteristics of the financial statements need to be kept in mind. For example, capital work in progress or related to borrowings or, like we discussed about virtual currency. So if these are material items, you need to make a disclosure in the financial statements, in the audit reports and in your financial statements, which are consolidated financial statements. Yeah.
Okay. So this is the whatever entities you are consolidating in your financial statements, you need to give this sort of chart there, where you will mention the name of the entities and what is the net assets of that entities, total assets minus liabilities. You need to mention that. What is the share of profit that entities in the consolidated financial statement, and what is the share in other comprehensive income and total comprehensive income. So this table you need to give related to all the entities so that it clearly depicts how much contribution is related to that entity into the consolidated financial statement. If you are not consolidating any entity, for whatever reasons, you need to mention those reasons, into the notes to accounts. Let's say you are in you do not receive, you have a subsidiary. For example, you have a subsidiary in China, and you are not able to receive financial information related to that entity due to any reasons, and you are not in position to consolidate it in your consolidated financial statement. You need to give a proper disclosure, notes, reasons into your financial statement about it.
So as I had mentioned that we need to ensure that your work papers are demonstrating that you have questioned and you have challenged whatever the management has done. So due to paucity of time, please carry on with the next section.
Okay, so next and last section is about the recent changes which has been done and it could impact the disclosures. So recently, if you see, last year, uh, there were a couple of key amendment has been done in the rules, accounting standard rules, and due to that, there are two new things which came. One is in Ind AS 1 and one is Ind AS 7 and 107. So 101 says, we have example in the next slide. It says that when you are deciding the current and non-current classification of the year end, then anything if has been anything cannot be decided based on the intention of the management. Okay, so you need to go by the documentary evidence. If let's say you have taken a loan and loan is for the 5 years, so you have shown it as non-current. But let's say management and come and say to you that we have an intention to repay it in next 12 months. So better to classify it as a current. So then you cannot only merely on the intention of the management, you cannot reclassify it as a current unless and until you have documentary evidence in your hand and you have gone through it and you are convinced that yes, it could be now shown as a current assets or current liabilities. So that is something which you need to take care of. Second aspect is related to supplier finance arrangement. If you have any supplier and you did the financing arrangement with some financer and you have repaid the amount to that supplier through that financer, then you need to disclose all these arrangement in your financial statements. That what could be the disclosure, that what was the carrying amount which you need to pay to the supplier, the finance provider, that what amount he has paid on your behalf to the supplier, what was the effective interest rate on that, what was the contractual credit period which was there originally with the supplier, that is something you need to mention. And now with the extended credit period, because now you have a separate arrangement with the finance provider, that extended credit period you also need to mention separately in the financial statements. So this table you need to give in that scenario where there is some supplier financing arrangement is there. Okay.
So there's a question before we go to Nafra. There are a couple of questions which I want to take. These are coming from the live audience. If an entity changes presentation or disclosure format from prior period to better clarity, how should comparative and explanation to be handled? So you need to please remember that merely mentioning that previous year numbers have been regrouped or reclassified where necessary. That line is not sufficient now. You'll have to mention which all have been changed and which all have been reclassified. Also, there's a next question. If a liability is expected to be settled through refinancing shortly after year end, but no agreement exists at the reporting date, can expected refinancing be considered in the classification? Absolutely no. Like, it was mentioned in the previous slides that management intention doesn't play a role when we are making a disclosure. It is the documentation part which will play an important role. If you do not have a documentary evidence in your hand, then you cannot make disclosure on the basis of intention or the estimation. So now, since the time is limited, we very quickly go through the findings of NAFRA, because these are directly hitting the auditors. There have been various kind of, can you go to the next slide? So there are kind of many observations which are very common, like unexplained manual calculations, outdated information placed in the audit file. Many times you receive one information, then the client gives you another information and the third information. The first information was incorrect, or it was still lying in the file just without explaining. Then, like we mentioned, that alteration of work papers post-archival is also one of the common finding, which you need to be careful about. Significant accounting policies missing in published or archived financial statements. We have discussed some of those, but you need to have a complete checklist of your Ind AS and Schedule 3 requirement, and that is how you will need to make sure that all the checkbox are there. Incorrect policy in ECL, expected credit loss. This is also one of the common finding. People may not be aware on it, but you need to ensure that you take help of an expert for ECL provisioning. Then sample selection. This is one of the common finding of NAFRA, that people say that, okay, we picked up these 25 samples, but how and why? This answer is not there in the audit documentation file. So you need to ensure that whatever basis on which you have taken the samples, that is consistent across all the audits which you are doing. And then your materiality calculations. You can do it on the top line, which is revenue. You can do it on profit. You can do it on asset. So if you can compare it and go most conservative way. But your materiality computation needs to be there in your work paper file. Go to the next slide. So new labor codes have come and there are requirements. Please ensure that if you are a preparer of financial statements, you need to look into the FAQs which have been issued by the Institute of Chartered Accountants of India. There was a webinar which was just on those FAQs, where we discussed how the accounting is going to get affected and how the auditors will need to ensure that the new labor code related effects have been taken into financial statements. Next slide. So basically, whatever there are some questions also coming which are related to labor code. Please remember that we are discussing about the disclosures and presentations. We are not getting into detailing of how a particular transactional detail we are not discussing here. We are discussing what is to be disclosed in the financial statements, whether the labor which has been, so some one of the question is labor has been shifted to another state, and then GST disclosures and all. So we are not getting into that direction. At present, we are just trying to say that whenever you are preparing the financial statement, it is an important consideration for you as a preparer of financial statements or as auditor of the financial statements, that the impact of this new labor code has been taken into consideration. So there can be financial impact, there can be changes in the structure of salaries, some estimates might have undergone a change, there can be contingency which might become applicable, like the definition of wages has changed, gratuity applicability on people who are short-term employees. Instead of more than 5 years, they may be more than 1 year. So there can be various places where the new labor code might impact your provisioning. It might impact your financial statements. All those disclosure notes need to be there. Next slide. So one important aspect, and this is our last slide, where we are saying that these impacts, because there is a change in the law, these have to be taken as an exceptional item. But please remember that materiality has to be kept in mind. This is one of the important characteristics, whether you are preparing the financial statements or whether you are auditing the financial statement. As per the framework, materiality becomes very important point. You cannot say that it's a very small change which has happened, but I want to show it as an exceptional item. No, it is not required. Only when the amount is material, then you will need to make a disclosure in the exception item. So what we did, just to recap, the important consideration for the financial year closed on 31st March 26. There are requirement under Schedule 3. There are requirement under the accounting standards. There are requirement due to new changes. So what are the consideration when you are preparing these financial statements, and what are the consideration when you are auditing these financial statements? As a qualified chartered accountant, you are supposed to have a look at these. And my recommendation is that you please have a complete checklist on the basis of which you will be carrying out your audits. So I think we have reached to the last slide, which very clearly says that thank you very much, and we will stop sharing the screen and we'll wait for we can have one or two questions. One question I have received. This question is Mr. Rahul has put up this question. If individually immaterial expenses are aggregated into single line item, but collectively become material to users of financial statement, does Ind AS 1 require reassessment of presentation on the face of the statement of profit and loss? So question is not very clear, but when we calculate the materiality, we calculate on the, like I had mentioned, we calculate it on the basis of the top line revenue, on the basis of profit, and on the basis of assets, whichever is applicable. Like company may be very large, but they may not have profits. They may be running into losses. Company may be very large, but might not be generating revenue in the current year. So whichever is most applicable on that company or that organization, we calculate materiality based on one of these formula. And then there are rule of thumb. If the materiality is calculated, then we also have materiality, which is sum of unadjusted materiality. If that materiality, that all unadjusted events, if you calculate and the total becomes more than materiality level, you will have to make adjustments or you will have to make a qualification on that. So with this, we close our session. I hand it over to the technical team of the institute. Thank you very much.
I think they are not there, so maybe I think we can conclude the session now. And we thank to all the participants who are there and spend their time.
Yeah, Mr. Rahul appeared. So over to you, Rahul.
Yes. So I would like to extend my heartful thanks to the chairman and vice chairman of the Accounting Standards Board in absentia for their guidance and leadership in conceptualizing and launching such informative webinars, enabling meaningful knowledge sharing for the benefit of our members and stakeholders. I would like to extend our sincere gratitude to our esteemed speakers for their insightful contributions and for covering the topic with such deep clarity. Lastly, but certainly not the least, I sincerely thank all the participants for their active presence and engagement throughout the session. Once again, thank all of you for your continued support and for being part of the ASB's ongoing efforts to promote learning and thought leadership in the field of financial reporting. Thanks to you.
Thank you very much.
Thank you.